We have been just discussing that this new anti-fragmentation tool needs to have certain features. So which are most important to you?
Well, first we are going to discuss it, so we have not decided everything. So I need to remain quite general, and it's going to be about the way I look at it. I'm not going to report on. First, it's really about multiple equilibria, about the risk that at some point markets would move to a bad equilibrium. And that's what we call unwarranted fragmentation. So to me what is important, if it's really a clear case of unwarranted fragmentation, we need to act. I mean, the case for acting is big. And of course we have some legal constraints, but conceptually we should just act without limits if it's clearly unwarranted. And there will be limits because of legal reasons, but conceptually. But it cuts both ways. I mean, at the end of the day, it's a fiscal issue. And if you don't have certainty or a level of comfort that is high enough that the fiscal positions are sound, then you cannot act, or you're restricted in the way you act. So it's really, to me, at the end of the day, if it's unwarranted, you act. If there is a fiscal problem, it's not for the ECB to play a big role.
Would the ally the nations have to go with a fiscal problem be the OMT, because then they also have, would have more pressure to reform?
Well, of course we have the OMT, and the OMT is still there, but we know OMT is an heavy machinery, and the thresholds for triggering OMT is really politically quite high. So having maybe some intermediate tool where you do something about it in conditions that would not, say, force a country to go to an ESM program, I think is something we will discuss, I mean, basically. Yeah. But I think the logic of the OMT that, you are going to act if there is a strong commitment from the countries to have a sustainable fiscal policy remains, the name of the game. And for instance, if we would have to be present in the market on a continuous basis, I think this would be a strong argument that it's probably more than just unwarranted fragmentation. So another way to put it is, if it's about unwarranted, you want a backstop to avoid market at some point to slip to a bad equilibrium, but not be present continuously on the market.
Yeah, but that brings us to a problem that we have to have a definition for unwarranted. Some analysts do say that, for example, the spread of 400 basis points between the core and the periphery would be unwarranted. But what kind of an idea do you have?
Well, I would be reluctant to have any automatic trigger, because it should be forward-looking and not backward-looking. A country might have had a very sound fiscal policy in the past. You have a new government that wants to do less sound things, and conversely, so it has to be forward-looking. And so this idea that there would be a fundamental spread that would be, stable in the time, I don't believe so. It really depends on the circumstances. So I think, to cut a long story short, that we should not have any triggers that are automatic, and keep flexibility. I wouldn't want us to be in a situation where we are forced to act when we don't feel comfortable, but also conversely, we feel we would want to act, but we have committed not to do it because we had this kind of trigger.
So it's more about the dynamic and the market speed, about pushing yields up. Is that right, my understanding?
That's certainly part of the story. If you have the impression that the markets are overreacting, then it's easier to react than if you have the impression you need to act on a continuous basis, because then you ask, why is the market getting wrong all the time? And not only because there is some form of panic and expectation re-anchoring to a bad equilibrium.
Let's talk about inflation, because clearly inflation is probably reaching a new record high this week. How concerned are you that we are seeing parts of that being entrenched in the system and also in the expectations?
Well, that's the question today. I mean, from what point inflation would get a sort of dynamics of its own, you can call it different ways, a sort of shift to a new regime like the BIS was saying, or just discontinuities. My take on it is, especially in Europe where it's a terms of trade shock, is you have to have an agreement on who's going to pay implicitly in the system, workers, firms, which firms. And it might be the case that you need various iterations, because firms have market power, workers have market power. We have a tight labor market. So the concern that you might need a number of iterations before they agree on who's going to pay could make the inflation process more persistent. And if this is the case, of course, we need to act, and we need to act more forcefully than we have acted in the past.
Yeah, for now the ECB has pre-committed to 2 interest rate hikes, one 25 basis points, the other one possibly 50. What's your idea? How many, or how big should the ECB go as a given?
My take on it is, I mean, roughly the first 200 basis points, so to go to positive 150, are more or less no-brainers if we're still in a positive growth environment, because real rates would still be negative then. And I don't think you take a lot of risk by moving to a place where real rates are still negative. And by the time we do that, we'll know a lot more about where inflation is going. So in a way, unless we have really bad news and maybe new shocks in terms of the real economy, I think the next 150, 200 basis points are more or less no-brainers, and we should act relatively fast on those.
What do you mean, like relatively fast, by early next year, or what's the time horizon?
I think the market's expectation is that we would do that by March. But in the meantime, we'll have so many inflation readings, so it could be faster, it could be slower, depending on the inflation readings. But again, I think we should move relatively fast on the first part of the normalization.
The ECB or the Eurosystem has been criticized for being very optimistic on their inflation outlook forecasts. So what do you think? When do we see material coming back of inflation?
Well, first, I mean, the fact that we've been optimistic, of course, our models have been calibrated, over a period where there was no inflation or very low inflation. So, models can only produce good results if they've been calibrated with some kind of volatility. And we have had repeated shocks. So the war, of course, was not foreseen. But indeed, beyond that, I think we should recognize that we've been surprised by the inflation dynamics and act accordingly, which basically we've decided to do. We are on a catching up phase, and we've decided that now was time to react forcefully to the inflation development. Yes.
So just one last question on Sintra. So what is like the topic number one on people's mind if you talk to your colleagues?
If I may, I will go back to the BIS meeting, because it was a bit more about short-term challenges. We talked a lot about energy here. It's really this risk that you will shift to a higher inflation regime, and so that if that risk exists, that you should be on the safe side and react accordingly. I think that was a very forceful message, and I tend to agree with that.
Yeah, and at the same time, we're sacrificing growth for the sake of getting inflation in control, right?
Well, that's not for us to decide. I mean, the big question is what kind of slowdown in growth you need for indeed people to agree on how to share the cost of this increase in energy prices. And we don't know. We'll see. But our mandate is price stability.
Yeah, it's a difficult job to do in these days. So
it's an interesting job. That's
indeed.
for sure. It's interesting.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.